Why do interest rates rise? Why do some countries borrow cheaply while others drown in debt? Today, we explore how interest rates are determined and why this matters so much for less developed countries struggling with rising debt levels. Interest rates refer to the payment made for the use of money, usually expressed as a percentage of the amount borrowed per year. There are different types of interest rates, including nominal interest rate, the stated rate of interest, real interest rate, nominal rate adjusted for inflation, pure rate of interest, the basic rate after removing risk, loan duration, and administrative costs. In reality, all interest rates are interconnected. A change in one often affects the others. The two main theories of interest rate determination. Economists mainly explain interest rate determination using the loanable funds theory, the liquidity preference theory. Let's break them down. The interest rate is determined by the demand for and supply of loanable funds. Supply of loanable funds comes from household savings, bank deposits, government surpluses, foreign capital inflows. Higher interest rates encourage more saving, increasing supply. Demand for loanable funds comes from businesses investing, governments borrowing, consumers taking loans. Higher interest rates reduce borrowing, lowering demand. Equilibrium. The interest rate settles where savings equal investment. Linked to less developed countries, LDCs. In many LDCs, savings levels are very low. Governments borrow heavily to finance budgets. Foreign lenders demand high-risk premiums. Result, high interest rates. This leads to rising public debt, costly debt servicing, reduced funds for health, education, and development. The loanable funds theory explains why scarcity of savings pushes interest rates up in poor countries. Liquidity preference theory, Keynes. Core idea. Proposed by John Maynard Keynes, this theory argues that interest rates are determined by demand for money, liquidity preference, supply of money, controlled by the central bank. Why do people demand money? People hold money for three reasons: transactions motive, day-to-day expenses, precautionary motive, emergencies, speculative motive, to avoid losses when interest rates are low. When interest rates are low, people prefer holding cash rather than bonds. Role of central banks. Central banks influence interest rates by increasing money supply, lower interest rates, reducing money supply, higher interest rates. Linked to less developed countries, LDCs. In many LDCs, inflation is high and unpredictable. People lack trust in financial systems. Governments print money to finance deficits. This increases demand for liquidity and raises interest rates. As a result, governments borrow at very high rates. Debt grows rapidly. Currency depreciation worsens external debt. The liquidity preference theory explains why macroeconomic instability keeps interest rates high in developing countries. How the two theories complement each other. Loanable funds theory focuses on real resources, savings, and investment. Liquidity preference theory focuses on money supply and monetary policy. Together they explain why interest rates differ across countries, why LDCs face persistent high borrowing costs, why debt becomes a long-term trap rather than a growth tool. Conclusion: interest rates are not just numbers. They reflect savings capacity, risk, monetary stability, investor confidence. For less developed countries, low savings, high risk, inflation, and weak institutions combine to push interest rates up, deepening debt burdens. Understanding these theories helps explain why debt relief, financial reform, and stable monetary policy are critical for sustainable development. If you found this explanation helpful, like the video, subscribe to the channel, and join the discussion in the comments. What role do you think interest rates play in Africa's debt crisis?